Mahesh Patil, Co-CIO, Birla Sun Life Mutual Fund as well, joins in on board. Mahesh, hi, morning. Seems like the market is pretty cautious ahead of the two big events, Fed as well as the RBI policy.
Yeah, good morning. Yeah, that's true. I think we have seen the market actually rise up in expectations of the election results, and then these two events really are key. I think on the policy front, clearly I think there is expectation of a 25 basis point kind of a rate hike looking at the inflation numbers. But I think inflation, if you really look at dissect those numbers, it's largely due to vegetable inflation and food inflation, which we actually seen signs of that moderating. So I think that should not really be read too much into it. And I think on the Fed policy, again, fears about tapering. I think our belief is that we should not expect any large tapering in this December, and probably it should happen somewhere in the first week of next calendar year. But I think this time we are well prepared, even if tapering happens, because on the current account deficit, we've seen a lot of easing over there. Our balance of payment situation is also pretty comfortable. So I think the reaction this time to such an event would be less muted than what we saw it last time.
Both for the bond markets as well as the equity markets, would that be the case? And how would you position yourself for equities then?
Well, I think very difficult to really position for any such kind of event. But I think by and large, our view has been that we are kind of at a cyclical bottom in terms of economy. And we should see a mild recovery going forward. Even from a rate perspective, we feel that the rates are at kind of peak levels with 10-year bond at close to around 9%. And with the likely view that inflation should ease off somewhere in by March next year. And you should see then moderation of interest rates. So in that view, I think we have been positively inclined on the market from a medium-term perspective. And also with a slight bias towards some of the cyclical stocks, though they have rallied recently, but any correction, I think one would like to increase exposure in cyclicals, especially in sectors like banking and financials.
Mahesh, you gave us the trade setup and how the markets could or could not react to the Fed tapering news as well. The question is on banking, because both the things, one, Fed tapering, two, what the RBI does, would have an impact there. How would you advise viewers or investors to look at banking here on?
Yeah. So the banking sector, if you look at it, currently the liquidity situation is pretty okay. So actually the borrowing in the MSF window is actually zero. So even if supposing RBI were to increase repo rate, actually it wouldn't have too much impact on the borrowing cost of the banks. So to that extent, I think to a large extent, because that's would be neutral to the banking sector. That's what we believe. And more importantly, from the banking and financial services sector, I think there are two concerns which have been there. One is on the increase in the NPAs, and because of the slowdown in the economy, and that's what hurt some of these banks, especially the PSU banks. So there again, while we are seeing some signs of easing over there, but that still remains a challenge going forward. The good thing is that we are seeing a lot of large accounts, which were potentially likely to be NPAs. There we are seeing some kind of a pressure by banks to do asset sales and deleveraging. So that cycle, I think, has begun, and that is good for some of the banks, especially banks which have lending to the large corporate side. So I think going forward from here on, if we believe that the economy would start to recover, and we have seen the bottom over there, then I think the stress on the asset quality should start to ease off, though it won't happen in the next immediate quarter, but over the next 2 or 3 quarters. And the fact that interest rates also kind of have peaked out, I don't think it will really lead to further increasing in the borrowing cost. So given these two factors and the fact that the valuations are pretty reasonable, I mean, we have seen a decent correction in the banking stocks over the last 1 year. So I think the outlook from here as we move forward looks to be favorable for the banking and financial services sector. Up till now, we have seen that the retail private sector banks, they have done much better because the retail part of the credit cycle has been pretty good. But I think increasingly, I think even some of the large banks focused on the corporate side, where the valuations are at significantly lower levels. And as we see some ease off in terms of asset quality pressures, I think those should also start to do well going forward.
IRB Infra, I just want to see what that stock is currently up to in trade, because it seems like that's had a very good start. Some order wins coming in for IRB Infrastructure. That's holding up by a good 4% as we speak. A 92-point uptick is what you're seeing on IRB Infrastructure. Besides that, of course, Apollo Tyres clearly the star in today's trading session. JP Power as well makes a decent move. On the flip side, the weakness is stuck to HDFC Bank, Coal India, Tata Power and Aurobindo Pharma after the significant run-up that you've seen in the stock. Today you're seeing a shade of red, so just a slight bit of profit taking is what you're seeing on Aurobindo Pharma. Good amount of open interest addition for Arvind Limited, Kotak Bank, Idea, HCL Technologies. These are all open interest gainers. Axis Bank and HDFC Bank really topping the charts with 3.5% build up coming in. Mahesh, what have you made of the entire tire space? And does that interest you, or does it seem like this is just a temporary blip up?
Well, the auto ancillary space, especially the tire companies, have seen a significant improvement in their profitability in the last quarter numbers. And essentially, it was driven by lowering of the raw material costs, especially rubber. So you've seen a margin expansion. And to some extent, while the OEM demand has been weak, we have seen the replacement demand being pretty okay. So with the change in mix, because OEM typically is a low margin kind of a business, and replacement is a higher margin, we have seen better numbers coming in. So I think with good numbers coming in and margin improvement, we have seen some re-rating happening in all the tire company names. But I think the key question here is how sustainable is the margin expansion, because benefit because of lower commodity prices, I think sooner or later would have to be passed on to the end consumer. So I think looking at the run-up, what we have seen in some of these stocks and the multiple, I think one would a bit cautious. But I think overall the outlook for the sector looks to be pretty good.
And is that corroborated by your view on the auto space as well? Because leaving aside the CV cycle, most of the other auto companies are trading pretty well, and the sell side seems to be bullish out here too.
Yeah, I mean, if you look at the autos, especially the two-wheelers and the four-wheelers, especially on the consumer side, I think we have seen last 1 year things have been pretty tepid. We have seen kind of a flattish growth. So I think going forward, as we see some recovery happening, I think next year one can again look back numbers to come back to somewhere in the low double digits or so. So I think with that kind of a recovery expected in the auto space and looking at the valuations, I think the sector outlook looks pretty good. And mind you, a lot of the auto companies, even in this downturn, have been able to protect their margins pretty well. They have been able to reduce costs and reduce the other expenses. So they have been able to increase margins. So as the volume growth picks up, I think the operating leverage should also come into play and should lead to higher earnings growth. So I think while the current scenario looks pretty depressing in terms of volume growth, but taking a slightly 1 year view or forward as we see a cyclical recovery, I think typically discretionary, I think the volume growth rebound, typically when we see from a bottom of the cycle, when in the next year, when the volume recover, they tend to actually overshoot on the other side. They are never near the long-term average, okay, which is 12-13%. So I think with that view, I think it's a sector which holds promise from the next 2-year perspective.
Sure. Mahesh, talk about two defensives and FMCG, an average P multiple for the large ones northwards of 30. IT, the average P multiple for the large ones, sub 20. Now, these are expensive stocks, yes, but do they have the room to move up further? Because everybody right now seems to be liking IT. Is that faith justified? And can the stocks give superior returns even after the rally that they've seen in the last 12 months?
Well, if you look at IT is not exactly a defensive. We've seen some cyclicality in IT also, depending on the growth in the developed markets. I mean, FMCG is a classic defensive. So there, clearly, I think the valuation overshoot on the upside in the FMCG sector is at an all-time high. It's almost like 2 sigma standard deviations above the long-term average. And in FMCG, we are seeing on the backdrop of some kind of a slowdown in consumption. We have seen in the last quarterly numbers, volumes have tend to be lower than the what we have seen in the last 1 year. So I think clearly there the risk reward doesn't seem to be favorable if you look at the sector by and large as a whole. On the IT side, if you look at on the other side, yeah, while the valuations have moved up a bit in the last 1 year or so, it's primarily driven by increasing two reasons. One is the outlook in terms of growth outlook for next year looks to be better than what we had seen last year. In fact, the IT budgets for next year are getting finalized, and the indication is that you'll see the IT spend, which was negative last year, would probably be around increase of around 1 to 3% or so. So that's bodes well good for IT stocks in terms of volume growth for next calendar year. And obviously companies have been also able to take benefit because of rupee depreciation. So I think IT is a sector where we are actually seeing earnings trajectory much stronger than what we have seen in the last couple of years. And to that extent, I would say the valuation re-rating which has happened is justified, and one could continue to see outperformance in this sector in the medium term.
Mahesh, what according to you is the market pricing in from the RBI this time around? Because given the IIP data, the inflation figures yesterday doesn't really give you a comforting feeling, and it seems like, it could be a rate hike anywhere between 50 to 25 basis points.
Yeah, I think from a market standpoint, I think a 25 basis point kind of a rate hike looks to be have been discounted, and I don't think it will make a material difference, okay, in terms of market outlook, because as I said earlier, the liquidity situation is pretty easy at this point in time, with the money coming in from the FCNRB deposits, so that has improved the liquidity situation in the banking system as a whole. So as I mentioned earlier, even a kind of a repo rate hike would not lead to any significant increase in the cost for the banking system. So I don't think it would lead to any significant change in our view on the market at this point in time.
Mind you, HDFC Bank is down 2.5 to 3%. We'll discuss that. But Mahesh, before we let you go, leave us with one pocket. Need not be a large cap space. Could be a set of stocks which are in the mid cap space, which you're confident about outperforming the markets over the next 12 months.
Well, I wouldn't like to comment on stocks specific, but I think there are sectors, I think especially in the capital goods sector, I think this is a sector, if at all we expect a recovery next year, and with a stable government at the center, I think that's an area I think which would be a thrust area. So I think in that sector, companies which are pretty strong in terms of capability, which have got enough capacity, and where the balance sheet is pretty strong, I think these are the companies I think which should be able to bounce back and do well over the next 2 to 3 years time frame. So that's the sector opportunity I think which one should be looking at closely to play the recovery next year.